What's up guys, Zane here from the Trading House. Hope y'all are having a great day. Today I got a video for you guys on how to trade credit spreads. I'm going to be doing a tutorial basically and showing you guys what I look for when constructing my spreads and just showing you what you can do with this really good strategy. So I'm going to come over to the profits tab in our Discord chat. And these are all the spreads that I signaled this week. Every single one of the spreads that I signaled expired worthless, which is exactly what you're looking for. That's the optimal outcome when you're trading spreads because you're essentially shorting an option. And when you short, anything really, you want it to go to zero because that's when you, the spread seller, can make the most money. So this is the Tesla 1100, 1110 calls, and I think the biggest profit we pulled from a spread was, yeah, this Amazon put credit spread yielded us 680. This is a good one. So I'm gonna come over to Apple right here on Robinhood, and as you can see, it's a little bit down today. I'm gonna come over to the trade Apple options, pull up the option chain, and we're going to be constructing a spread for the June 26th expiration. I usually like to trade weeklies just because I can create the spread, collect the premium, and then rinse and repeat every week. And since they don't have a lot of time on them, the theta decay tends to ramp up in the last few days, which is great for us premium sellers because we make money when implied volatility goes down, theta decay takes place, and yeah. So for Apple, we're gonna come down. Okay, so for most people, when they open up an option chain on any stock, they see buy a call, buy a put. Well, with spreads, it's essentially inversed, where a call credit spread would be a bearish position because you're shorting the call, and a put credit spread would be a bullish position because you're shorting the put. So for Apple, these last few weeks, I've been trading mostly put credit spreads just because Apple seems to only want to go up. And that's okay because we can take an advantage of that with credit spreads. So we're going to go over here to sell a put. Before you buy anything, you're first going to sell. And that's the premise of this strategy. You're shorting the option. So what I look for before picking which strike I want to go short on, I always check this middle column right here, the chance of profit. This tells you how out of the money the option is. And the sweet spot that I've determined from trading spreads is anywhere in the high 85s to the high 90s. They yield the perfect amount of credit and they keep your risk relatively low. Credit spreads in general are less risky than trading naked options just because you won't be a victim of theta decay and IV crush, implied volatility crush. So on this chain, I'm liking, yeah, let's go with the 325. So I'm going to short 325. This is the 325 put, and I'm going to buy the option directly under it, which is the 322.5 put. And I'm going to open that one up too. Okay, and as you can see, Robinhood recognizes that we want to open a put credit spread position. Make sure this says put credit spread and not debit spread. Debit spreads are another strategy that we'll talk about in another video. So right here you can see the order. So as you notice, we're opening to sell this position, shorting, and we are opening to buy the option under it. And basically you're gonna ask next probably, why do we open the option below it? Shorting naked puts is very risky, and to do it you need an immense amount of capital because for example, if you go over here and we just want to short the put, right, we'll receive 89 cents in credit per spread. Let's say we pull in 89 and we review the order. As you can see, it requires $32,000 of capital. Now, not everyone has that in their account. Most people don't. So in order to collect premium on Apple puts, we can convert this regular short put into a credit spread position. And how you do that is you go back here and we are going to buy a put. You buy the strike directly under it and you hit continue. And here we can see, actually I think it's still been updated. Let me redo it. So we're selling the 325, buying, okay. Okay, here we go. As you can see, from one put credit spread, we're going to yield $14 of premium. And in situations like this, since $14 isn't that much, I usually size these positions up to about 10 contracts, but for the sake of simplicity, I'm gonna keep it at 1. So you can hit review order, and it's going to double ask you if you're trading a credit or a debit spread, in this case credit. It's good that they ask that. I know a lot of new traders get confused, and I have once accidentally tried to execute a debit spread when I wanted to open a credit spread instead. So here we're going to get all of the information on our spread, contract 1, limit price. That's not that important, but here's where it gets important, is our minimum credit. For selling this spread, we are going to receive a net credit of $14. That net credit is determined by the difference between these two premiums. Because you're shorting the one that's more expensive and you're buying the one that's cheaper, the difference is that extra money, that credit, is going to be credited to your account for selling the spread. Now, on the back end of this, the broker, your broker, in this case Robinhood, it could be any broker, is going to collect a collateral to hold aside in case you have to cover the potential losses of this position. Now, I know when anyone hears broker and them holding collateral, they freak out and say, like, why are they taking the money up front? They're not taking the money, they're just setting it aside. They're going to take it from your cash position, how much ever cash you have in your account. They're going to take it from that and set it aside in case you have to cover losses on this if this trade goes against you. Now, another thing to note on spreads is that the collateral is calculated by the difference of the two strike prices. So as you notice here, this is the 325 strike, and we are, close this, we're going to short that by this, right? The difference, $2.50 times 100, because we're trading options. It's always a multiple of 100, and that tells us our total collateral. So yeah, that pretty much sums it up. The only other thing that I could say is to remember that when you're selling spreads, you are selling to open the position, and when you want to close the position, you are going to buy yourself out of the position. Now, usually when I trade spreads, I let them expire worthless, just because most of the time that's how it works out. But sometimes if there's, 1 cent of premium left on the Apple contract and you still have to hold it for, let's just say, another week, it's not worth holding that contract for another week just to get another dollar premium out of it. At that point, it's better just to buy that position back in the market and close your position. And yeah, usually when I make like 90 to 95% of my max gain, I usually just close the position just because I don't want some surprise volatility sneaking up on me and potentially costing me the entire trade. Alright, that's the whole video on credit spreads. I hope you guys found that helpful.